Okay, so here's a run through of the asset classes that you can trade. We're going to first start off by having a look at the capital markets. These are the markets for stocks and bonds, ultimately a place for companies, governments to raise capital. We'll move on to that in a moment. Beyond there, we'll move on to currency markets, probably something that you've heard a lot of, particularly in the retail space. This is the most promoted product to trade. Beyond there, we'll then go and have a look finally at commodity markets and futures and options, which ultimately is where you will actually trade. And so an understanding of how futures and options relate to the underlying market is obviously very important. Within this, we'll go through some of the key influences on each market. Each market varies, but you'll see some very common themes that run throughout all of the markets. We'll also have a look at who uses the markets in particular and how they're all interlinked. You know, it's very difficult to trade, say, bonds without understanding what's going on in the currency market, for example. So we'll have a look through some of those, and then we'll dispel a few myths. There's a lot of myths that go around in this industry, and some of the things that you perhaps may have wondered, perhaps some of them you feel are silly questions, but they're not always. If you've got a silly question, chances are it's because no one else is willing to ask it. Like any market, capital markets are based on supply and demand. In the capital markets, you have a supply of cash, and you then have a demand for cash. The supply comes from individual savers, companies with excess cash. They want to put this to work. They want to earn some kind of return on it. The demand for cash comes from companies needing to expand to grow production. So that's essentially how the markets work. How do they work specifically? A company or government will essentially want to borrow money, and an investor, a saver, will lend the money. So when you put your money in a bank account, you're essentially lending the money to the bank. That's why you get an interest rate back. So let's have a quick look. Shares to start with. You've got a company, they want to sell some shares, they want to expand into Asia, they want to develop a new product, whatever it is, they want some cash. So to do that, they're going to give up a bit of ownership of the company. You've seen this on Dragon's Den, that kind of idea. They're going to give up some ownership of the company to the buyer of the shares. And also, as they progress, chances are you may well get a dividend. Now, the buyer of the shares, what they get is they get ownership in a company, but this is also a risk. You don't know how the company's going to fare in the future. Obviously, if you're buying shares in a company, you think they're going to do quite well. But you are essentially taking on a risk that the value of your shares is going to fluctuate, and you may or may not get a dividend. In return, the company gets the cash that they need to do whatever they have decided that they intend on doing. Now, the difference between shares and bonds are that with a bond, you are gaining as a buyer a security and interest. So the security of the asset comes from the fact that you're going to get repaid it. If you buy a bond, essentially you will get repaid the amount of money that you purchased that bond for at a preset time in the future. You will also get a set interest rate on a yearly basis as well. Again, the transfer the other way is cash to the company or government who needs the cash for whatever reason it is. But it's perhaps a more short-term thing. They know that they're intending on pay it back. The company will pay it back by using revenues from the future. Government will pay this back by tax revenues that they bring in from the economy. So let's have a look at how a company actually raises the capital by selling shares. What will happen is you'll have an initial public offering. This is where a company will sell its shares, and ultimately these shares will then move on to an exchange to be traded. So how do they go about this? They don't just phone people up and see if you want some shares. What happens is the company will contact a bank, maybe a couple of banks, that will advise on how much they can get for the shares, how much the company is valued at. The banks will then underwrite the shares. What this means is that the bank will guarantee the company to sell all the shares that they want and give them X amount of money. So the banks have now taken on this liability. This is in the primary market. You can't trade anything in the primary market. This is the job of creating new securities and then getting the cash to the companies that need it. So the banks have now got all of these shares. What they'll do is they will then sell them off to pension funds, mutual funds, investors, all of their clients. They will get rid of all these shares. Now, once they've sold all of the shares, they can then be traded on a public exchange. This is where the shares are listed on LSE, the NYSE, NASDAQ, whatever exchange the company decides that they want their shares listed on. Obviously, it depends on what country you're in. You can't necessarily sell all your shares on the New York Stock Exchange if you're a UK company, but ultimately the shares will be there on an exchange to be traded. That is where anyone can then come and buy the shares. You'll contact a broker and you'll be able to buy and sell the shares. The company by then has already got the money. They are still interested in the shares, of course, because the owners of the company maintain some degree of shareholding, which gives them the rights to decide how the company has moved forward, as long as they've got over 50%. So that is how shares get sold. Ultimately, you can't trade anything until it is in the secondary market and on an exchange. It's a very similar process for government corporate bonds as well. Corporate bonds will be placed with a bank. The bank will then phone around and essentially get a variety of prices for these bonds before they are then sold. So very similar process, and the bonds are then sold off in an auction. So that is how companies will raise capital via share sales or via a corporate bond. Ultimately, you're not going to be able to trade them until they're in the secondary market. And this is also the market that derivatives are priced from, what is known as the underlying market. So the market for the actual shares, the actual ownership of company, is called the underlying market or the secondary market. Government bonds are slightly different. They're auctioned by the government to primary dealers. Now, primary dealers are a certain panel of banks, institutions selected by the government. This is quite a privileged position to be in. If you're a primary dealer, you are there to potentially buy any new issuance of government bonds. Government bonds are generally considered the safest asset you can buy, the reason being that they are backed by a government who has enormous tax revenues, so they can virtually guarantee to pay you back your investment. So, once the bonds have been sold to the primary dealers, they can then once again be sold into the secondary market, and that is where they can be purchased. Now, government bonds, corporate bonds do not trade on an exchange in the same way as shares. They're done OTC, which means over the counter. This means that they're traded via banks for specific amounts. There will not be one set exchange traded price. It will be more the case that I will say, I will sell you £5 million worth of these UK government bonds at X price. It then becomes a negotiation on the price. And so you have sort of an auction process. You have a bid and an offer for the bonds, as opposed to in an exchange where you can very clearly see what the bid and offered price is. With government bonds, it is all done individually in individual trades. So they can either be sold into the secondary market. However, the other privilege of being a primary dealer is that you can lend the bonds or use the bonds as collateral. So if you want to take out a very large loan or a shorter term overnight loan, the bonds can then be used as collateral for that loan. So it's a guarantee that you'll pay them back. It's similar to how a mortgage works, that the bank holds the deeds for the mortgage as their collateral. You then pay it back. So that is how government bonds differ slightly, and also a little bit of how they're used by the banks that are primary dealers, and also other banks once they have acquired these bonds as well. They're not just there to be sold on and moved around for those reasons. So the shares are out in the secondary market. They're there to be traded. So you're going to buy some shares in the company. You're not going to do this without knowing what's going to influence these shares. And so the first thing that you need to be looking at is quarterly earnings. As it says, they're released quarterly. the key thing that you want to be looking for is the earnings per share. Now, obviously, there's a lot more that goes into it as well. You can be looking at the revenues in terms of companies, say Apple, for example. One of the key parts of the earnings release is the cost per unit, i.e. how much an iPhone sells for. But those are intrinsic to certain companies. Ultimately, the easiest way to gauge a company compared to any other is the earnings per share. Now, this is the earnings for that quarter divided by the number of shares. So that's what you want to be looking out for. Key companies that we look out for whilst we're trading here. In the UK, there's really 3 or 4. You've got the very big companies in the index, but ultimately Glaxo, HSBC, and the 2 oil majors, Shell and BP. These are the big influences on the FTSE. The reason that I've listed these as well is because of the time that they're released. Glaxo earnings are released around about midday. The majority of European company earnings are released prior to the cash open of the market. So it doesn't actually give you necessarily a trade opportunity, but will influence where the market opens. So the important thing is the earnings that can actually be traded during market hours. So that, as I say, excludes the majority of European share reports. In terms of the US, they do it slightly differently. Some companies report during market hours, or certainly during hours that we can trade. It's called pre-market in the US because they are released an hour before the markets actually open over there, but they will impact on the futures markets. So there's an opportunity to trade them there. And then there are a few, particularly the tech companies that release post-market. But again, futures are still open, so there is still an opportunity to trade these shares. Now in America, these companies have a bigger influence. The US stock market is the biggest in the world. The US economy is the biggest in the world. So this affects everything. Everything is linked to the US, particularly in finance. And so any movement in share prices over there will have a knock-on effect and will drag around other markets. So the key things to be watching out for over there. The banks. This was a major focus quite a few years ago, and it still can come back. All shares will swing in and out of focus, in and out of, I guess, popularity of what's being watched. The 2 biggest banks, or the 2 key banks to watch, JP Morgan and Goldman Sachs. So keep your eyes out for their earnings. Earnings aren't released at a specific time, but there is a pre-planned date and an approximate time that they will be released. So both of these come around about 1 o'clock in the afternoon UK time. Beyond that, you've then got a lot of the tech companies. These at the moment are very, very popular. Now this could all change in the future, but the big ones there are Facebook, Amazon, Google, Apple and Microsoft. So do keep your eyes on that. Beyond that, you're then looking at large employers, companies known as bellwethers, some companies that have their fingers in a lot of pies. So give a good overall view of the economy. Walmart is the biggest employer in America, so extremely important there. More to give a gauge on the economy as a whole, particularly in relation to employment. General Electric, they're across all sorts of different industries, so any kind of movement in General Electric's earnings could be at least a reasonable indicator of the whole economy. And also beyond that, Boeing, because of the nature of their business, aircraft, contributes a lot to GDP because the size of their sales are enormous. You know, a plane does not sell for a small amount of money. So Boeing's earnings are also very well watched. Again, they are a rather large employer. So what else influences shares? Buybacks. A buyback happens, or a reason for a buyback is that a company perhaps has excess money on their balance sheet. They need to use up some of their cash. And again, this is that supply of cash versus demand for it. So what they can do is they can actually buy back some of their shares. What this does is this brings more ownership back to the company, or to the company as a whole. But what it also generally does, at least short term, and this is the difference between looking at this as a longer term thing and a trading opportunity. The trading opportunity lies in that if a company announces a buyback, they've then got to go and buy those shares. And that is going to drive up the price of the shares as they come into the market and buy and buy and buy and push the price of the shares up. So be very aware of that. In terms of trading an index, so the FTSE, the S&P 500, it's only going to be the very large companies with extremely large buybacks. They're actually going to influence the whole market. They've got to drag the whole market to be able to do that. So again, you are going to be focused on the aforementioned companies and their earnings. Their earnings and their company buybacks. Beyond their M&A, the key thing with M&A is that you need to know the components of your index. There's no point in hearing that, I don't know, Chrysler are going to buy BMW and not knowing what to do with it. What would happen in that instance is, as a general rule, Chrysler shares would fall because they have got a major cash outgoing there. They've got to raise capital, so this is going to come in the form of more corporate borrowing. They may have to issue more shares, and that is going to depress their share price. On the other side, this money is obviously going to flow towards BMW. They're going to want to buy the shares. Usually they will also give an indication at the price that they're willing to pay for them. So say BMW shares are trading at 200 and Chrysler come in and say we will pay 300, the share price is very quickly going to move up, because if you can buy the shares at 210, 220, you already know that Chrysler is very likely to buy them off you for 300, banking you an 80 point win. So that is why M&A is very important. It's extremely important to understand what companies are in the index that you're trading, and also the size of those companies as well. Once again, the bigger the company, the bigger the influence on the index. Secondary issuance. I just covered this in the sense of a company buying another company, needing to raise more capital to create additional products. So secondary issuance, they will be selling more shares. What does this do? It dilutes the total number of shares in the market. Now, anything that gets diluted brings the value of those individual shares down. It may not change the actual value of the company. What will happen is the company selling the shares will just lose an amount of ownership of the company, but it dilutes the total number of shares in issuance, and that brings the value down as a general rule. Again, this does indicate that a company going forward is trying to progress, is raising capital, and if this is deemed as a good thing for the company, if it's deemed as a sound business decision, then of course the shares will eventually rise back up. But initially, as a trading opportunity, an additional secondary issuance is generally seen as a negative thing for the share price. And finally, sentiment. This is something that really cannot be overlooked. Just because the company is doing absolutely fine, their sales are good, they seem to be a very good company, they can be dragged down by other companies in their sector that are perhaps performing a little bit more poorly, because it has the potential that they're going to follow in the lead of whatever company is struggling. Is this something that's going to knock on, or is it just that one company is just not doing particularly well? The best example of this recently was VW and the other German car makers. VW had a scandal whereby they were potentially going to be sued by the American government, or certainly in a class action situation, and fined quite heavily for tricking the emissions regulations. They got computerized devices in their cars that tricked the amount of emissions that they were giving out, and so they were potentially going to be given a very hefty fine. This obviously was very detrimental to VW share prices. They dropped very heavily, but what it also did was drag down the share prices of BMW and Daimler, who are also in the German stock market and in obviously the same sector, the automobile sector. So we'll go and have a quick look at that chart. Here you can see it. VW is the orange line at the bottom, and then the top two, green is BMW and purple is Daimler. What you can see is at the beginning of the scandal, this was on the 18th of September, VW shares got absolutely slammed. The horizontal line you see is a rebasing, so all the shares started at the same level percentage wise. What you can see is VW got really slammed here, but it did also bring down BMW and Mercedes, Daimler, because of the possibility that this could roll out and you could see the regulators punishing both of those companies. What then happened is we started to see a bit of recovery. Later on, we then saw the possibility of 2 class action lawsuits against VW, which again dragged the VW shares straight back down, nearly to the lows that were previously seen. Beyond that, you then got later on in November, other manufacturers were being investigated in Germany. So as soon as this was announced, you knew who they were. That was BMW, that was Daimler. Now, because VW shares had already been hit so much, you would think this would be more bad news. But what would happen is if you've already sold these shares, you're better then to buy them back and sell the Daimler and BMW shares. Think about it, how far can the VW shares go on another investigation? Is it going to be any worse than what's already happened to them? Whereas Daimler and BMW are now directly being implicated. As it happened, this dragged on for quite a long time, and all the shares did recover a little bit. But as you can see, VW left significantly lower, and also this probably stunted BMW and Daimler's rises that were currently happening. First thing you need to understand when trading bond markets is bond yields. Now, a bond is sold with a par value, a maturity, and a fixed coupon. This is where the term fixed income market comes from, that you are getting a fixed rate of return on the bond that you purchase. So, say for example, you buy a $1,000 government bond with a 5-year maturity and a 4% coupon. This means that in 5 years' time, you will receive your $1,000 back, plus, in the meantime, you will receive $40 per year in interest on that bond. Now, where does the yield come in? The yield comes in based on the current price of the bond. So, essentially, it comes in as a percentage based on the coupon divided by the current price times 100 to give you the percentage. Now, the coupon, remember, doesn't change. This will always be $40. So, if the current value of this bond then drops to, say, $800, you're still getting $40 back per year, giving you a 5% yield, $40 being 5% of 800. Take this to a greater extreme, and $40 as a percentage of 200, if the government bond falls that far, will in fact be giving you a 20% yield. So pretty big change there based on the move in the price. So the key thing, always have in your mind, as price falls, yields will rise, and the exact opposite. They will never move in the same direction. Also, do keep in mind yield charts. These are very, very important. Key yield levels may stop the price of a bond moving without you actually really realizing why. It could stop in the middle of nowhere, and you're thinking, well, there's no reason for it to stop here, until you actually notice a yield level. So keep your eyes on very key yield levels. I'm not saying you need a chart all day long, but just be very aware of certain levels that will be very well watched, very clear, large daily levels on those charts. So that is bond yields. Bonds have 3 main influences, being monetary policy, inflation, and creditworthiness. So let's have a little look at monetary policy first. Monetary policy affects the short end. This is where it is most applicable. because a change of interest rate, if you're, say, trading a 6-month bond, is going to have the greatest influence, as opposed to the value of that bond being eroded by time in the case of a longer bond. So let's have a little think about, if interest rates are suddenly cut, how does this affect the bonds that are already outstanding in the secondary market? Well, bonds with a higher yield are suddenly a lot more attractive. So these are then bought, and as the price rises, this depresses the yield and brings it in line with the new interest rate that has been set by the central bank. So that is where the greatest influence is. Of course, it will affect bonds all the way along the curve. So the longer end, again, will be influenced by this interest rate dip, and that will make all bonds generally more attractive. So in the case of inflation, which we will get onto in a moment, QE is also the other main increase in value of shorter end bonds. Again, this does the same as a cut in interest rates, but rather than doing this by decreasing yield, making high yielding bonds more attractive, what it does is it puts a bid into the market, because the central bank is actually going to buy the bonds themselves. So they maintain a buying flow into the market. This increases the value of the bonds, makes them more attractive, because you know there is someone there to buy them from you. So inflation, as I said, this affects the longer end a little bit more. So I'm looking at bonds beyond 5 years, or maturity beyond 5 years. Now, the reason that this happens is, think about that yield that you're getting. Those $40 that you're getting on that 4% yield, as time goes on, are worth less and less. That is the effect of inflation. It depreciates the value of your money. So we all know the idea of a Mars bar used to cost 30p, now costs 65, or used to cost 40 if you're a little bit younger than me. So what happens here is these longer bonds, because that yield effectively will buy you less and less in the future, they actually become less attractive, because your income is going to be diminished. So what that does is that depresses the value of them, and then brings their yield to a higher level, and then that compensates for the increase in inflation. The further out you go, you start looking 10, 30 years, then of course you're affected even further. Now finally, we'll have a little look at creditworthiness. Bonds that are backed by governments that have a very large base to collect taxes from, so richer nations that can collect a larger amount of tax, are more able to pay back the value of the bond. And like an investor, like anyone, everyone has a credit worthiness, and this is judged by ratings agencies. You hear of bonds being rated AAA, BB, C. All of these ratings do affect people's willingness to buy certain bonds. So more bonds, US in particular, are more attractive. Now you get a spread between different countries. So give you an example, if the German 10 years are trading at 1% and Spanish yields are 4%, you have a spread of 3%. This is known as your risk premium that you gain for buying Spanish bonds over German bonds. Essentially, the less creditworthy a nation, the higher the yield their bonds will be. This is an extreme example. That is not the current risk premium between the two, but that is just there to illustrate it. Beyond that, you then also have a flight to quality. What this means is, in times of economic uncertainty, panic, people want to keep their investments safe. If you move towards bonds backed by a government that is very creditworthy, then you're putting your money somewhere very safe. Yes, you will not get a great amount of yield on it. Take, for example, Germany, 1%. You won't get a great yield. However, your money is safe there. You know that you will be paid back if you hold on to those bonds as time goes on. So they offer security. And generally, again, this is a generalization, bonds will move inversely to stocks. As uncertainty increases, stocks are then sold and positions are moved into bonds to grab a deal of safety. Currency markets are exactly that. They're a market for the exchange of one currency into another. So every currency is valued in terms of another, depending upon what you're buying it in. So you could have €1 maybe equal to 80 pence in Britain. However, it might buy you $1.10 in America. So that is the way the relationship works. So effectively, if you have a euro sterling rate, so in this case it would be 0.8, you would then, that is also effectively a spread between the euro, dollar, and the sterling against the dollar. So if you, for example, see the euro and sterling gaining against the dollar, but the euro sterling rate not moving, what that's telling you is that the dollar is becoming weaker and both the euro and the pound are moving against it. So you can use one rate to give you a clue as to what is actually the main mover behind some of the other rates. Just like bonds, there is no central clearing house, there is no centralized exchange. Most transactions are done through OTC via banks and also through EBS, the electronic brokerage system, and this accounts for about 25% of currency trading. It is the most traded market in the world in terms of volume put through daily. This is something very often quoted, but this does include all types of transactions. So it includes your spot transactions, your outright forwards, FX swaps, etc., etc. So it makes it sound a very impressive market and very, very large. So let's just give you a little bit of terminology. The spot price is the price that you currently see, and these trades will be cleared within 2 days. So if you agree to trade at the spot price, you will get your money within 2 days of trading. Move into an outright forward. An outright forward is very much like a futures contract. I'll explain futures contracts in a moment. And essentially it is a bespoke contract agreed between two people for the delivery of X amount at a specific time. So it's a bespoke contract, and you'll see how it's very akin to a futures contract in a moment. And then you've also got FX swaps. These are the three that account for the most volume in the FX markets. FX swaps are a way of managing your risk, your cash flow at the moment. So there will be a spot transaction as well as a forward transaction, giving each party, they can swap the currencies that they need, but also with a forward contract as well, which guarantees them that they will also swap the money back in future for a agreed amount as well. So that's the basis of a FX swap. Doesn't necessarily really influence the way you're going to trade the markets individually, but is worth being aware of them. Right, currencies can be influenced by vast array of things. Obviously the goods that a country produces is the main reason that people want to buy a certain currency. Now beyond that, you've got monetary policy and interest rates. If, say, for example, interest rates are rising in a country, then this makes savings in that country more attractive. If you invest your money into a savings account in a country with a high interest rate, then you're going to be getting a greater return on your money, and that is why a certain currency may attract more investment and take more money into that country. However, why are interest rates rising? Often this is because of inflation. So if you've got a country with very quickly, rapidly rising inflation, then the money that you are putting into that currency is going to be eroded quite quickly. And so actually you can see the opposite effect, where people will move their money out of a currency. This selling of the currency to buy a different currency, because you can't own one currency without selling another. This selling of the currency to get away from the rapidly increasing inflation, which is diminishing the value of your currency, will then depress the value of the currency further. So that is the issue with inflation and monetary policy. It is a case of how well the monetary policy is being used to manage the inflation. Is the inflation getting out of control, or is it, to be expected, normal-ish kind of inflation, in which case additional interest rates makes a certain currency more attractive. Intervention, big impact here. This, at the moment, generally does seem to come from the Bank of Japan. The reason the country will intervene is, say, perhaps to keep their currency weak. If your currency is weak, then the goods that you are exporting become more attractive to foreign buyers. So if you're a country that is a big exporter with a weaker currency, then your goods are more attractive, therefore you get more money coming into your currency. This then raises the value of your currency. So the intervention comes in to try and maintain that lower level, which is beneficial to your exporters. So how is this done? Either the country can use its reserves, so it can sell its own currency to buy a different one, therefore that extra supply of currency depresses the value, or alternatively, they can use verbal intervention, the threats that they will begin to sell their own currency, the threat that perhaps they will reduce interest rates in this near future. This is how they can do it verbally, and the fact that they are saying that they may well do it, the market does need to price this in. You wouldn't want to assume that they won't, and then they do. You're stuck with currency that is very quickly becoming less and less valuable. So the market will start to price this in from a verbal intervention. Beyond that, you've got fiscal policy. The country increases borrowing. It increases the burden that it has to pay this borrowing back. This could then potentially reduce the creditworthiness of the country. But this increased borrowing also ends up with, it increases the supply of money in the economy, which again can push up inflation rates as well. So that's why expansionary fiscal policy can sometimes not be that beneficial to a currency. But again, looking from the other side, it will increase growth in the country. And so the expansionary fiscal policy can actually be seen as a positive and drive demand for the currency. So it, once again, it all comes down to the position the country's in, perhaps within the business cycle, the way their markets currently are, and that is what influences it there. Beyond that, you've then also got diversity and stability. Countries that are very diverse aren't affected by particular commodities, but when we look at commodity currencies, what I mean by this is currencies that are affected very strongly by certain commodities. New Zealand's a good example. The New Zealand dollar is affected very much by milk prices because they are one of the world's biggest, well, they are the biggest exporter of milk in the world. So their economy is very, very tied to the price of milk. Likewise, Canada is very linked to oil. So a drop in the oil prices means that the earnings going into Canada are less, and therefore Canadian dollar is worth a little bit less. So they're very well linked, certain commodity currencies, to whatever commodity it is. Likewise, minerals in Australia and Russia are also very well linked to commodities. Finally, political instability. If you suddenly get a lot of uncertainty within an economy, there will be a rush to remove your money because you don't know what's going to happen there. So again, you get selling of a certain currency. This is particularly prevalent in the South African rand towards the end of 2015, and I will just show you a chart of that in a moment. So here we have a couple of examples of intervention. Firstly, you have a verbal intervention. This was done by one of the members of the Bank of Japan, and what he came out and said, he said, new intervention is very much still in the toolkit. Therefore, the market prices it in. The chart that you're seeing on the left is the dollar against the yen. So dollar strength is the market moving higher, which is also yen weakness. So you see the yen becomes weaker as the dollar gets bought. And again, you see the same thing on the right-hand chart. This is the dollar against the South African rand. And when the uncertainty came from their finance minister being fired, there was a rush to take money out of South Africa because you didn't know who was coming in next. You didn't know what their policies were going to be. And so it creates an amount of uncertainty and depresses the value of the currency. And that is what you're seeing in both of those charts there. One from intervention, one from uncertainty. Commodity markets. These are the markets for physical goods. Now, you've got two areas of the commodity markets. You've got the spot market, and this is the market for actually trade in the physical goods
right now. So the buying of oil, buying the actual barrels of oil right now. And you've then got the futures market. The futures market is for the delivery of a certain amount of goods at a specific time in the future. And as I say, we'll get onto futures a little bit more in a moment. And this is where futures markets develop from the commodities markets. Now you've got 4 different areas of the commodity markets. Firstly, you have the energy market. This is oil, gas, products that are used to create energy with. That also includes coal, heating oil. You've then got the agriculturals, known as ags. This is wheat, coffee, anything that basically you can eat. Although it does also extend a little bit further into things like cotton as well, anything that can be grown. Beyond there, you've got livestock. So these are pork bellies, live cattle. These can all be bunched into futures contracts as well. And finally, metals, gold, silver, platinum, copper, etc. These are also to a degree split between precious metals that are more akin to cash and industrial metals that are actually used for creating things like tin, zinc, copper, lead, those kind of markets. So slight difference there, but all commodity markets do work in essentially the same way. Now, because commodity markets are dealing with a physical asset rather than cash in terms of stocks and bonds and currencies obviously being cash, there is a cost of carry involved. If you've got 200 tons of coffee, you've got to put that somewhere. You can't just keep it. You know, if it's a stock, you can have them as a stock certificate somewhere, and it doesn't really cost you anything in terms of storage and logistical transportation costs. So this is also embedded into the price, and this is why a commodity future in general will cost more than the spot price, because it's got to also take into account that if you're getting something in 6 months' time, someone has got to pay for the storage of that commodity until you receive it. So that is where the cost of carry is added into the futures price. And finally, who are they used by? The majority of people in these markets are the producers or the end users of these products, going to market to get the best prices and also to hedge their risk, to actually manage the price that they're going to get the items at. And that is the aim of the commodity markets. The US dollar has a very big influence on commodity prices. Reason being, the majority of commodities are priced in dollars. So if the dollar rises in value, you need more of your currency to buy dollars, which effectively makes commodities more expensive in your own currency. This in turn then reduces demand for commodities and depresses the price of them. This can only go so far in the sense that people do still need the commodities, so demand will remain. However, from a trader's point of view, a very sudden increase in strength of the dollar can have a knock-on decrease in price in commodities, and likewise the other way around. So something to keep your eyes on. Next up, we've got geopolitics and OPEC. Firstly, OPEC is the Organization of Petroleum Exporting Countries, and this is focused around a small group of countries, predominantly in the Middle East. The biggest of OPEC is Saudi Arabia, followed by Iran and Iraq. And they will come to an agreement on how much production they are going to do over a certain period of time. This obviously has a very big impact on the price of oil. They will then release whether they're going to increase or decrease production, and consequently, if you see a decrease in production, the price is generally going to rise. Beyond that, because commodities are produced in generally a smaller number of countries, any geopolitical issues in those countries is going to have a direct knock-on impact to the commodities produced there. So we saw this with Ukraine when Russia was looking to invade them or annex parts of Ukraine. This had an impact on natural gas prices, because there are a lot of natural gas pipelines that pump gas from Russia, one of the largest producers, to Europe, a an area that doesn't produce a great deal of natural gas at all. So that's where geopolitical impact comes in. Next up, you've got supply and demand, and then substitutes. In terms of supply and demand, this changes as countries, certain economies advance. We saw this in China. As China became a richer and richer country, demand for pork bellies went up. Meat is generally more expensive than grain, and so you saw an increased demand for pork bellies as China's spending power increased, and also a decrease in demand for grain, because that was often used as a substitute for meat because of the fact that it is that much cheaper. Also, you have substitutes, and this can again have an impact on the price of the main commodity. So if you're looking at shale gas, for example, and shale oil, this can have an impact on the value of oil, of gas, because this extra production coming to market will limit the price increase. However, because production costs of shale gas are that much higher than normal natural gas, it means that it only becomes a viable product above a certain value, and so you need the value to rise above that, and in a way it can have a slight capping impact on a commodity. And finally, inventories. As you know, commodities are physical, and so items that spoil, thinking particularly agricultural futures or agricultural products, if someone has got a very large inventory, it is going to spoil if it's held on to. So the inventory can be dumped, and this can have a very depressive impact on the market. It effectively becomes a fire sale, where you get a lot of selling, a lot of inventory coming to market, because if they don't take some money for it now, effectively it will rot, and then it will be worthless. Also, where the inventories are held is very important as well. The main hub for WTI crude futures, so the main oil futures in the US, is at Cushing, Oklahoma. This is where the futures are priced from. So if you've got a big supply in Cushing, even if production is falling, which would generally increase the price because there's less and less of the commodity around, the large supply at Cushing can always be pushed into the market and effectively can maintain a lower price of oil. And in fact, if it is suddenly released into the market, then it can actually depress the price of oil despite the fact of production cuts. So we're on to the derivatives market, futures and options. I'm not going to go into other complex derivatives involving CDSs, CDOs, swaps, etc., but feel free to read up on them when the time comes that they are relevant once again to the markets that we're trading. Then of course there will be quite a few streams on that. So where did futures and options come from? The idea is they're used to hedge the underlying asset, hence why they are a derivative of either stocks, bonds, commodities, future currencies. They all started in commodity markets, the idea being that you arranged with someone else a contract to deliver a specific amount of a product on a certain date for a certain price. This was a forward contract because they were all negotiated individually from person to person. They then became standardized, so every oil contract, for example, every gold contract would then be for a standard amount. So what could then happen is the contracts could then be exchange traded, because everyone knew exactly what you would get if you bought one contract, two contracts, 3, 4, 5, etc. So that is how they eventually developed into exchange traded contracts. And we also saw the proliferation of bond, equity and currency futures as well, used to hedge your risk in the underlying asset. So how do futures work? It's a contract to provide delivery on a specific date of a specific quantity of a good or asset for a specific price, the price being the price that you paid in the futures market on the exchange. Also, big thing to note with futures contracts, they are leveraged. So one oil contract includes in it 1,000 barrels of oil. Therefore, if you buy a contract for $50 a barrel, effectively the contract is worth $50,000. 1,000 barrels times the $50. This means that you do not need a particularly big price increase to actually make quite a lot of money on a futures contract. You only need a 1 cent increase in the value of a WTI oil contract, and this will give you a $10 profit, that being 1,000 times the 1 cent. So you can see how you can make and lose a lot of money very quickly with futures contracts, and that is why they are very well traded and something that, you know, they're very well speculated on. Now, moving on to options. What do options do? Options, they give the right to the buyer of the option, but not the obligation to buy or sell a future or a specific asset at a specific price in the future. Now, they do not actually have to take up the option. When we get to the strike price, as you'll see in the next video, you don't actually have to take the option, you just lose the premium on the option. The seller, on the other hand, they're known as the writer, they get paid the premium. So the premium is essentially your insurance to guarantee that you can buy your futures or your asset at a certain price when the option expires. The writer gets that premium, but they then shoulder the risk that the current price could be a lot higher, and they have still got to provide you with the asset at the original agreed price. So 2 different types of options. You have a call option. This is the right to buy, and you have a put option. This is the right to sell, again, beyond a specific price or at a specific strike price. And that's the key to futures and options.
Okay, the futures market is a market for managing risk. Now, in this example, we're going to take a look at a farmer and a baker. Now, the risk for a farmer who's producing wheat is that the value of wheat falls by the time he harvests his wheat and comes to sell it. The value may well have dropped. That is a risk to the farmer because he's already had his outlay of staffing costs, fueling his machinery. So he wants the price to stay up. The risk for the baker is that the price rises. They've already agreed a price to sell their bread at to a supermarket, and so they've got to produce it for that price. It is going to squeeze their profit margins if the price of wheat goes higher and higher. So what happens is they will enter into a contract for a price that they're both quite happy with. And so in 3 months' time, the farmer will deliver the baker 1,000 bushels of wheat, and the baker will pay $100 a bushel for them in this example. Now, what this means is that their risk for both of them is reduced. They're both getting what they want for their wheat. They're both getting a price that they're happy with for the right amount. So it doesn't matter if wheat at the beginning of the contract was at 80 and it moves around like this and keeps going up and down and eventually drops. It doesn't matter. They've got it for 100. They're both more than happy with that. It meets both of their needs. So that is fine. What happens in the real world, though, is a little bit different because it is very rare that you find a farmer who has got the exact amount to sell that a baker wants, and both for the exact price. Obviously, the baker is going to want it at a much lower price than the farmer is willing to sell it at. So, what happens in the real world? The two, or we'll look at the farmer to start with, will enter into a futures contract. So, he enters into a futures contract with a trader who buys a futures contract from the farmer. So what this means is that the farmer is now short. He has sold the contract, and the trader is now long. So the farmer's risk that prices would fall are now a benefit to his futures contract. If he has sold a futures contract at 100 and the price goes down, his futures contract increases in value. Likewise, the same contract to the trader who is long. If the price goes down, his contract is losing money. So, what actually happens? As the price changes over time, say it does end up dipping down, the trader is going to get given the 1,000 bushels of wheat, and he is going to pay the farmer 100 for them. Now, if the price has dropped down here to 50, the trader now gets 1,000 bushels and he can sell them to someone else for 50. So he is banking himself a $50 loss per bushel, equating to a rather unhealthy $50,000 loss. Not something that he's going to want. So that is what happens in reality, that the trader is the one who ends up having to pay the farmer. And what he can then do is the trader doesn't actually have to hold on to this contract. He can then sell it once again onto trader 2. And he might sell it to him for, say the price is dropping, he'll sell it for $98. Now, that's a much better deal than losing 50,000. He's only now lost 2,000. And what may then happen is this trader may sell them on. But by then, the price has actually risen back up to, excuse me for writing the wrong colour, the price is now back up to 105. So he has actually banked himself a nice $7,000 win. And all throughout this, no one has actually paid the farmer yet because the contract has not yet expired. Come the expiry, that is when someone has to pay. So how does that work? Who actually pays and who gets the produce? What happens is all trades are cleared through what is known as a clearinghouse. So what this does is the clearinghouse reduces the risk that someone could go out of business and suddenly decide, actually, I'm just not going to pay you, and so you don't get the money. What happens is, come the expiry of the contract in 3 months' time, the clearinghouse will take all of the various people who are long, and they will have to pay for however many contracts they have at the current price. All the people who are short, i.e. the farmers, will have to deliver the bushels, and the traders, or whoever else it may be, could well be the bakers, will pay for them, and the clearinghouse will disseminate the products. Now, one final thing, and this is where futures do become a little bit confusing, is, as I said at the beginning, the futures contract that we were talking about was $100 per bushel for 1,000 bushels. Now, the trader doesn't have to actually pay a full 100,000 for the contract. What the trader has to do is put up what's called margin. Now, the margin is an amount that theoretically should cover the one-day fluctuation in the price of wheat. So, say the margin is 5%. The trader is effectively buying $100,000 worth of wheat, but only has to put down $5,000. Now, this is where you can make and lose a lot of money. You've only put down $5,000.
say the wheat price does continue higher and you hold on to this contract and it goes up to 120, you're now making $20,000 on the contract, but it is only giving you an outlay of 5,000. So what happens then is you have effectively made a 400% win on your contract, or on the expenditure, despite the fact that the contract has only gone up by 20%. So that is where it manages cash flow, because the person buying it doesn't need to have the full expenditure. So if you're the baker in this example and you are buying the contract for the future, you only have to spend 5,000 right now just to maintain the position that you have until you either sell the contract or you take delivery. When you take delivery, you get your margin back and you then get the bushels. So that is how the leverage works in a futures contract, in that it offers you the opportunity to make a huge amount more money, but likewise $5,000 can be eaten up very quickly by a move of only 5% in the actual value of the contract. So that is how futures trading and futures markets work. The options market, very closely linked to the futures in the sense that it is a different way of hedging. It is also linked to the futures, that you can actually hedge your futures positions with options. So let's have a look at it from just purely a hedging point of view to start with. We'll go back to our old example of the baker, and as we can recall, the baker's risk was that price rises. So, excuse me, what they did before is they bought a futures contract, $100 per bushel, which meant that it did not matter what the market did. The market could range, it could trend down, it could trend up. They eliminated any price fluctuation risk and paid 100. So we'll call 100 this price. So there's your $100. Now, if come when they take delivery of the wheat, the price is in fact down here at 50. Buying those futures is not looking like such a bright idea, because they're paying basically $50 over the odds. However, if you're trading up here at 130, they have gone and saved themselves $30 per bushel, which is quite a significant saving. Now, how else could they do this without buying the futures, without having that margin outlay for the futures? What they could do is they could buy an option. In their case, because the risk is a price rise, they will be buying a call option. Now, the call option gives you the right, but not the obligation, to buy futures at a specified strike price when the option matures. So say the option matures in 3 months' time, and we'll call their strike price $100. So when the options expire, they can, if they wish, buy the wheat for $100. Now, if the options expire down here at 70, what they will do is they will not exercise the option. They won't buy the wheat up at 100. Instead, they will just buy the wheat at the price it's currently trading down at 70. If, however, we are trading up here at 130, they can exercise their option, take the wheat futures at 100, and then sell them for the current price at 130, banking themselves $30 per bushel, and that will cover the cost of now paying the market price of 130. However, you're not going to get an option for nothing. Someone's got to actually write you this option and take the other side of the trade. So what does that person want? The person writing the option, selling you the option, will want a premium. And we're going to give
their premium of $5. In this example, I'm not going to go into strict details on why, but we're going to call it $5 you paid a premium for this option, which in fact means that you don't make 30 when we're trading 130 because you've got to cover the premium. So you're actually only better off once it's trading above 105. So if you are buying options, you've got to factor in the premium cost of it. And so if wheat is trading higher around the 130 mark, they've actually paid 105 for their wheat, not the 100 that they would have if they'd done it via futures. However, it does mean that you don't have to pay a specified price that you've already agreed. And so if the market is trading at 70 in 3 months' time, they will simply not exercise the option and buy the wheat at 70. However, they will have to add the $5 to it because that's the premium that they have already had as an outlay. Now, where does this premium price come from? The premium is based on a few things. Chiefly, the time until expiry, because the longer you have until expiry, the longer the greater the possibility of reaching the strike price. On top of that, you have got the distance from the strike as well. If we're trading down at 50, a strike of 100 could be quite a cheap premium, and you may only pay $2 when it's down at 50 because that is a long way. It's got to double in price to get up to the 100. However, if you're trading up at 90, the premium may cost you $8 because you are very close to the strike price, therefore meaning that you need to get over 98 before you are actually in profit. And this is where the baker could also use his options, that when we are trading lower, down at 70, they could buy call options for 90, pay the $8 premium, and they're actually going to be better off because their full cost, if the price does keep rising, they will pay 98 for their wheat, the 90 plus the premium if the strike price, if the options expire above the strike price. Now, if you want a lot more detail on how options are priced, in terms of time, volatility, there's quite a lot that goes into it. Do have a read up on Black-Scholes or Black-Scholes, however you wish to pronounce it, and that they have a very big options pricing model, very technical. They won a Nobel Prize for it. So look up on the Black-Scholes option pricing model. But beyond the theory, why does this matter? You're trading futures, why does it matter about the options? Well, what it matters is that when the options expire, people will take delivery of the futures, in this case at 100 on that strike price. If we're now trading up at 130, how do they take their profit? They sell the futures. So you get selling pressure in the futures market as people take their profit on the options. So knowing when option expiries are, and also this is the slightly more difficult thing, knowing which options have the most interest in will indicate to you what could happen come the expiry, and you will certainly see a little bit more volatility around options expiries because of this repositioning as people take their profit to cover the price variation. So that is why the options market is very important, and also how options are used. Put options will be the exact opposite, and basically we flip this chart over, it would look exactly the same but for a put option where you're protecting your downside. So let me just give you a quick couple of charts which explain how price varies with puts and calls. So let's look at call options over here in blue and puts over here in red. Now with a call option, put here P&L and market price. So P&L going from 50, 0, minus 50 we'll call it, and this is the market price of 10, 20, 30, 40 and
50. Now, for the buyer of the call option, they will pay a premium, as we showed you in the previous example. So, say they pay a premium of $10 and the strike price is 20. So this is the strike price on the option. The buyer of the option is out of the money until they get to 20. As soon as we pass 20, they are starting to cover their premium, and then once through 30, they are making profit, so they are in the money once they're above 30. Conversely, the seller, the writer of the option, is making a profit until we get to 20, and as soon as the option is exercised, they are then making a loss, and they have potentially an unlimited loss. Their loss will continue in line with how the price moves. So for the seller, that is your big risk, whereas the buyer will only ever risk the 10. The seller will have to sell you the futures at 20, irrespective of where you're currently trading. So let's have a look at puts. Puts work the exact opposite. So we'll once again go back to your 50, your 0, your minus 50. I'm not going to put the actual prices on this. You know what they were. So basically, we work backwards on a put option, because remember, this chart is not showing time, this chart is showing price. So for the buyer of the put option, you are out of the money until you hit the strike price, and then once you've covered the premium, you are then starting to make a profit as the price falls in that direction. And again, for the person writing the option, you have then got the exact opposite, whereby as the price falls, you incur losses once you have gone through the strike price here. So that is a brief explanation or a brief chart just to remind you of who is earning what by owning or writing certain options. So that is how the options market works. Okay then, quick explanation of margin and leverage. So the reason that futures are traded with margin is that you don't have to invest the whole amount to start with. If you're willing, in the example of the farmer and the baker, if you're willing to invest 100,000 straight up, why wouldn't you just buy the materials right now? So yes, there is the part that you want the items in the future. You don't want them right now. So you're not going to pay, if you're the baker, the $1,000 or 100,000 for the 1,000 bushels straight off now. There's no guarantee that the farmer is actually going to deliver them. He may have a bad harvest for whatever reason, or just decide, you know what, I don't want to deliver them for 100,000. So what happens is you have a clearer. Slightly poor clearinghouse, but there you go, there's a clearinghouse. So what happens is each party puts up what is called margin. In this case, we'll use the example that they put up $5,000 of margin. 5,000 represents 5% of the total contract value. Now, what this should cover in theory is if the market moves up or down by 5%, the amount of margin that you have with the clearer will cover the amount of loss to the value of your futures contract. So therefore, you're always maintaining a credit worthiness in the sense that you always have the margin at least to cover the initial loss for the day. What you will then have, should your margin start to dwindle, you will then get a margin call and you'll have to put up some extra margin. So say the futures price drops to 96, so that wipes off 4%, so your margin is now minus 4,000. They will ask you to add 4,000 of margin,
to bring your margin balance back to maintain the credit that you have. So what this effectively means is that everyone maintains a credit worthiness and no one has direct exposure to each other, mitigating the risk of, say, the farmer or the baker going bust in the future and not being able to pay up. Now, what else does this leverage do? From the point of trading, and this is why futures markets are very popular to trade, the leverage also means that with a reasonably small investment, you can control a large amount of money. So if in this example you have a margin of 5,000,